So I think we'll get started. I'd like to welcome everybody to this panel discussion on short-termism and investment. We've got a bunch of really interesting panelists here whose opinions I'm certainly interested in learning about. So we've got Jan Eberly, Alex Edmans, and Thomas Philippon. And the way I'm going to organize this is I'm going to start out with a simple introduction to this idea of short-termism and investment and what is and what might not be short-termism. And then I'm going to hand it off to the panelists whom I'm sure will have very diverse opinions, which is why I picked them. And so let's get started. So I want to start out, when I was thinking about doing this session, I thought, well, what is short-termism and what isn't it? And I thought, well, maybe it's a good idea to start thinking about what isn't short-termism. So suppose firms maximize something that looks like this. So firm value is they pick investment over some infinite horizon to maximize the expected present value of future dividends. And then what are dividends? Dividends are just some profit. So that's a function in a very, very simple model of capital and shocks minus investment. And then what's investment? Well, it adds to capital. So tomorrow's capital T plus 1 is depreciated capital today plus investment. That's a canonical investment model. You can make it a lot more complicated, but if firms follow something like this, then they're not being short-termism. And that probably holds even if there are things like pricing kernels. So it's not just a constant discount factor. If there are more factors of production, so there doesn't just need to be capital, there physical capital, there could be intangible capital, labor, materials, what have you. There could be adjustment costs, there could be all sorts of things that make this model a little bit more richer. But as long as firms are maximizing some objective function that looks like this, I think it's safe to say that they're not being short-termist. One thing that's really important in a framework like this is that in a framework like this, they shouldn't respond to IID shocks. So what isn't short-termism? I was thinking about what if you have an outside investor who has a short-term horizon, and they're maximizing something that looks like this. So the only difference I have here is before I had infinity, and now I've got cap T. So the outside investor has some sort of truncated horizon, but is not necessarily short-termist as long as he sells at a fair market price, because the investors to whom he sells are going to keep on solving the same maximization problem, and it shouldn't matter at all. Okay. Now, so those are things I think that we can eliminate as short-termism, but what else might be induced short-termism? Financial frictions induce something that looks like short-termism, but I don't think is actually something you'd call short-termism. So let's start with my simple little canonical model where for the firm value is just the present discounted value of dividends. And let's add another stock. So let's say that investment has to be less than profits, or dividends have to be greater than 0. So there've been a lot of people who've played around with this model. I think if you, like my dissertation was constraints delay investment. That certainly looks like short-termism. Or Nathalie Moyen's second chapter of her dissertation, firms facing potential constraints under response to shocks. There's a couple of problems with thinking about this as short-termism. One, any sort of friction is hard to distinguish one from the other. So financial frictions are hard to distinguish from real frictions, like real adjustment costs. And so it looks like short-termism, but it's not really based on any sort of preferences or expectations. And so I think that financial frictions we can probably rule out as thinking about short-termism. So what can induce short-termism? Expectations. And there's been some really interesting new work on expectations. So Jose Barrero's dissertation is about over extrapolation. And so he's got some neat data from the Atlanta Fed, and he shows that managers over extrapolate. He plugs this into a macro model and shows that managers overreact. Then there's this other nice paper by Bordalo, Gianaiole, Schleifer, and Terry, and they use diagnostic expectations, which is firms overreacting to mistakes they made in the past. And that also leads to overreaction to shocks. And we can think of that as short-termism. And in particular, they can react to shocks that are here today, gone tomorrow, that a rational manager shouldn't react to. There's also been an enormous amount of really interesting work using experiments and surveys of expectations. So there's a couple of nice papers, and it looks like expectations are probably not rational the way we think of them in our canonical models. So I think that's one important thing that can induce short-termism. Another thing is obviously non-exponential discounting. So all we've got here is a very standard hyperbolic discounting model which is time inconsistent because this beta never changes. So the firm here always puts too much weight on stuff that happens in the beginning. There's an interesting paper, it just came out in the JME. It's a finite horizon model, but they show that hyperbolic discounting elicits underinvestment. So I think that's something we can think of as certainly inducing short-termism. So we've ruled out financial frictions, but we've got expectations and discounting. And then the thing I think that Alex is going to talk about a lot, and something that I've done some work on, is convex compensation schemes. So let's say that the firm is not just maximizing its value, but some manager is maximizing his or her utility, and they're still picking investment, and they're still trying to maximize dividends, but this is just a very reduced form way of saying that they need to beat yesterday's earnings. So they get penalized, their utility goes down if they don't meet some earnings target. And there are a variety of compensation schemes that folks have thought about that will induce this kind of behavior. So I've done a little bit of work on this with Stephen Teria and Nastya Zakolukina. And if in a situation like these, managers react to IID shocks, and so they, even though a rational manager would do nothing in response to a here today, gone tomorrow shock, managers that face these kinds of convex compensation schemes do react. Interestingly, they react because they only react to intangible investment because that's expensible, and I'll talk about that in a bit. Something else that's been true is that the accounting literature has thought about these convex compensation schemes and short-termism for years. And I think that the economists and finance folks have been a little bit slow to the game in coming to think about this. So there's Sugata Roy Chowdhury's dissertation and the many papers that cite it that talk about real earnings management in the face of these non-convex compensation schemes. And then there's a paper by Alex, which I'm sure he will talk about, which is quite nice. I want to talk a little bit in the face of non-convex compensation schemes. This only matters if investment is expensible, because these non-convex compensation schemes means that managers want to beat earnings targets. But if investment isn't expensible, then it doesn't matter for earnings. And so something that the Tax and Jobs Cut Act of 2017 did is they allow 100% depreciation for short-lived assets. It's in place for 5 years, and then it gets phased out after 2026. So if managers do have these convex incentives, then this act increases short-termism relative to before. And I say relative because I'm pretty sure that the tax system in place before 2017 was not optimal. So it's not clear that the new short-termism is more or less optimal, but there's certainly more likely to be more short-termism. And then I have one last thing to talk about before I turn it over to Jan. So I think it's impossible to talk about short-termism without mentioning this paper. So this is Jeremy Stein's 1989 paper. And the idea is very simple. It's also hard to put into a dynamic framework without putting pages and pages of math, but the intuition is very straightforward. So firms can cut investment to deliver profits today, not because profits are intrinsically useful, but because they contain a strategic signaling value that's rationally priced by investors and that managers value because they want to maximize the stock price. So I hope that this offers a useful introduction to a topic that I think the other panelists will have a lot more to say about. Okay, Jan, it's your turn.
Okay, thanks, Toni. So first, I want to thank Toni for organizing this session and inviting me to be part of it. Toni's setup, I think, is perfect. I'm going to present some data that I think fits nicely in the structure that she laid out for us. And I want to mention up front that much of the data work that I'll present is from joint work with various co-authors, Nicholas Cruzet, Jonathan Haskell, and Paul Meisen. So I want to set the frame here by thinking about what problem are we trying to solve. And what was implicit in Toni's presentation of the structure she laid out was that the concern is that there's an underinvestment problem. And one explanation for that could be short-termism, and I think Toni framed that nicely for what is and what might not be short-termism. And we'll hear, I think, more from Alex and Thomas about evidence and ideas about whether those are credible explanations or what the mechanism might be. I want to think about the underinvestment question and look at some data. First, by framing, why is it we're concerned about investment per se? Why focus on that question? Because investment intrinsically is foregoing consumption today in order to have capital and output in the future. So it's a signal of the dynamic trade-offs that firms are making and that implicitly the whole economy is making. So when we examine that trade-off, I want to draw three distinctions and sort of break out investment in three different ways. First, investment versus capital. We may be interested in investment per se, but probably what we're interested in is the productive capital stock. And there's a layer between investment and capital. The second, Toni mentioned this, is tangible versus intangible capital. And then the third is we're mostly focused on private sector investment and especially corporate investment. But I want to show you some data also on public investment because there's spillovers there as well. So as I look at these compositional effects, I want to turn to two pieces of evidence that I think shed some light on whether we have underinvestment or not. One is to look at the effect of demographics. The demographic shift going on around the world is evident in almost all aspects of the global economy, and it turns out it may be affecting investment as well. And then I want to highlight some new work focusing on how we measure capital, and maybe there's some investment in place or some capital in place that we haven't focused on before. So first, what problem are we trying to solve? And this shows investment as a share of GDP for different components of investment. So the purple here, the bottom layer, is structures, non-residential. And then the blue layer is equipment. And so these together are the usual corporate capital stock. that we're thinking of. This is all private sector, private investment. And you see that in total, as a share of GDP, there's been a slight trend downward over time. And I think this has highlighted and drawn more attention to the question of underinvestment in the economy. Now, I want to add, this is aggregate national accounts data. So the measure of intangibles here is fairly narrow. It's intellectual property products. But you see, to the extent that there's been an upward trend or improvement in investment as a share of GDP, it comes from this intangible component, intellectual property products, which has sort of held up investment as physical capital or physical investment has fallen as a share of GDP. And then I'm going to add residential to the top. And when I first made these charts, I put residential in for completeness. But since we're all, or most of us at least, are attending this conference from our homes, and residential capital has become probably a more important consideration. And this is a point I want to return to at the end. Okay, so overall, it looks like there's a mild downward trend, but upheld a bit by intellectual property products. But that creates an issue. So this is the gross investment that was in the previous slide. So it's about 20% of GDP over time. But the concern is that that's gross investment. Right. So to get to capital accumulation, what we need is net investment. So we have to subtract out depreciation, which is this orange line, the consumption of fixed capital. And so when you subtract that out, the investment that's actually going into place, that's increasing the productive capital stock in the economy, is substantially smaller, was pretty steady between 5 and 10% of GDP until you get to the 1990s. It hits a trough in the financial crisis, but there's a much more distinct downward trend because this shift toward intangible capital brings along with it a higher average depreciation rate because intangible capital depreciates at a higher rate. So when you accumulate that into the capital stock relative to GDP, and I've shifted this to real terms, you get more concern, I think, about whether there's underinvestment this is underinvestment in the economy. It's not dispositive, of course. This is just measuring the total capital stock. Now, equipment, there's an upward trend because when you move from nominal to real, you take into account the declining relative price of equipment. And so that increases the capital stock. Non-residential structures are enormous as a measure or as a component of the capital stock, but trending down over time. And then we add in the intellectual property products, which are rising, but because of the high depreciation rate, don't play as big a role in the capital stock as they do in investment. Okay. So overall here you see that capital stock relative to GDP has declined somewhat, basically 1.4 times GDP to just over 1.2 times GDP. And that's the private sector, okay? If you really want to look for something that looks like underinvestment or short-termism, then you should go to government investment. This is gross and net again. So gross government investment has declined as a share of GDP pretty steadily since the 1960s. This is not a story about increased depreciation because public sector investment has a very small share of intangibles, which I'm going to return to in a second. That might be a problem of its own. But net government investment is trending towards zero over time, which means that the capital stock, and I'll just build up the stacks here, government fixed assets relative to GDP have declined pretty precipitously from about 1.2 times GDP to about 3/4 of GDP over time. So if you're looking for an underinvestment problem. This is the private sector capital stock relative to GDP I showed you before. If you add in the government fixed assets, you get a decline of about 1/4 in the capital to GDP ratio in the US. So I think this is the sort of data that make people wonder and focus on this question of under investment. If you want to say, so why does this matter, right? We're thinking about the productive capability of the economy. One reason to care not just about the capital stock, but about investment is research and a number of models showing a link between new investment and productivity. That it's not just the productive capital stock, but investment in R&D, for example, may increase productivity. So I had mentioned the federal investment. So here I'm going to turn a little bit more to composition rather than just the level of the capital stock. So this is federal R&D. This is in real dollars, not share of GDP. So it's been declining as a share of GDP steadily over time. But if you look at the composition of spending on R&D, you see it's really interesting. You see modern history reflected dramatically in the federal budget. So this component, which is now 20% of the R&D spending, space and technology. So you see the space race in the 1960s. And then the space race declines over time. And the big increase in federal R&D spending has been on health. And so the NIH and other health R&D institutions have benefited dramatically. So the overall level has declined over time relative to GDP, but the relative amount spent on health has increased. So why that reallocation relative to the space race? Well, this I suspect has a lot to do with demographics. That there has been much more spending on health R&D as there's been a shift toward greater demand for health services, especially as the population has aged. And so I want to show just one chart from a paper I've been working on with colleagues at Northwestern that look at where does this R&D go. So it's more toward health. We've seen that already. But even within health, this shows the share of new drug candidates. So when new drug trials are put through, they report who the target patients are of that drug by age. And what you see reported here is an increasing share over time of drugs that are targeted toward patients over age 65. So it's a very strong demographic effect that as the share of the population and the share of patients over 65 has gone up, there are more drugs targeting them. And we show in the paper that the shift in R&D has been even larger than the population shift. So there's even a disproportionate shift. And if you lower the age cutoff a bit, you see an even more dramatic shift. So why does this matter for productivity? One could certainly see that there's social and welfare improvements to improving the lives and the lifespan of seniors in the economy. But if what one is concerned about with health expenditures is, say, labor force productivity or labor force participation, one would probably want to target our investments in human capital at workers who are participating in the labor force. So there's a potential dichotomy between where we're investing R&D and the parts of investment that might increase productivity and output and provide greater output in the future. The other last point I want to make on the composition of investment, and this one is, I hope, a little more optimistic, is to look at labor and output during COVID. Surprisingly, to be a little optimistic. So we've all seen the output data that US GDP, usually the number we see is that it declined at a 31% annual rate in the second quarter of 2020. That's the annualized rate. It was a 9% quarterly decline. I'm going to be using some data from the UK because they measure some utilization metrics that we don't have in the US data. So I'm going to flip over and look at the decline in hours worked, which was 13% quarterly in both the US and the UK. So you saw that sort of similar labor market movements. But what we can see clearly in the UK, they have a survey of decision makers. The decision makers panel showed that work on premises, so instead of just looking at total hours, which declined by 13%, work on premises fell by 36%. So if you were just looking at the output that was produced by firms, if the output elasticity of labor is 2/3, then output should have fallen by 24% quarterly, rather than only 9%, which is catastrophic already. Capital, and because we're thinking about investment, we looked at the capital effect. Capital would actually make this worse, because if you have 36% of workers, or a 36% decline in workers on premises, that means that the productive capital at work should be declining similarly. So you should have underutilized capital in the business sector on premises. So we've tried to measure that in various ways. You can measure it using this work at home percentage. So workers shifting toward home rather than work, which would translate into underutilization of capital at work. There's also pretty good data on electricity utilization in the commercial sector, which fell by 25 log points. And so if you apply a 1/3 output elasticity to that 25 log points, and you'd have to say the output would fall by an additional 8% because of the underutilization of capital. So both of those suggest that a baseline reduction of output would have been 25 to 30%. And so as awful as the decline has been, of course, the countervailing effect has been apparently a lot of output produced at home. And that's why I put up the residential capital at the beginning. But residential capital is not enough to produce the output, because you still need to be able to connect your residential capital to your workplace, essentially, to create a new workspace. So work from home has been much reported. In the UK, the number of employees that report in this survey, traditionally working from home had been about 14% and pretty stable, rose to 35% in the second quarter and has been pretty stable since then. There's survey estimates in the US that are even higher. So the question is, what capital did they use? We've tried to get an estimate of that using growth accounting. So we have measures of labor force, work on premises. And we have two different measures of using capital at home. One is this energy index, which is in the next to the last column. And so that gives you an index of capital at work. And then we have a measure of capital used at home, which depends on this work from home measure. So putting those together, and I won't go through the details of it, you can see the contributions. This is the decline in output on the left-hand side in Q2 and Q3 relative to the fourth quarter of 2019. You see the decline in labor at work in the second column. The increase in labor at home is about 11 percentage points. The decrease in capital at work is about 12 percentage points in Q2. I'm just looking at Q2 for the moment. But the increased contribution of capital at home is about 6% of GDP. And that's pretty substantial number. And obviously there are other ways to measure this, but what we're estimating is this, what we call potential capital, the capital that was put to use because of the crisis, which wasn't previously utilized, is a pretty substantial share of GDP. And one thing we're going to see, I think, coming into the next quarter is that businesses will report higher productivity because they're measuring higher output, lower labor input, and sort of free use of capital at home. And so they will come up with a solo residual, which is in the right-hand column, that instead of being a small negative is a large positive because they're adding in this capital from home. So this potential capital, this is not the first time we've seen this. This is essentially what Uber and Airbnb are relying on, which is using personal capital for business use. But in the crisis with COVID, we're seeing this connectivity plus residential capital being used at such a large scale that it's visible as a large percentage of the macroeconomy. It is, just to wrap up, positively associated with intangible capital at the firm and sector level. So industries that have more intangible capital, which is on the horizontal axis, also have a much larger share of working from home. So it, in the cross section, lines up with this expenditure on connectivity or the kind of intangible capital that makes work from home more feasible. So implications for this, so perhaps the internet is not such a disappointment for productivity after all. My colleague Bob Gordon would argue that, or has argued, that all of these investments in what I've been calling connectivity and intangibility don't add up to very much for the capital stock and for productivity. But perhaps the resilience of the crisis has given them their moment, and we should be thinking about their productivity a bit differently. Of course, the distributional implications are no less concerning and problematic than in every other aspect of COVID, because the industries where you see this resilience are also the industries where you have what my British colleagues called the chattering classes, the higher education, higher income parts of the economy. But on an upside, we've essentially discovered 5 to 6% of GDP in this crisis by using capital that we weren't using before. So perhaps the underinvestment problem that we're seeking to solve is not as severe as you might think, just based on looking at the investment data. So let me stop there and turn it over to Alex.
Great. I'd say thanks so much to Toni. It's great to be here and to share my views on this topic. So what I've entitled my presentation is short-termism a problem? And you might think, well, that's an absurd question, because isn't the answer yes, right? Everybody seems to believe it's a problem. It's almost got to the point that to be accepted into polite society, you need to explain how capitalism is short-termist and we need to radically change it. But instead, what I want to do is have a much more nuanced perspective on this and to look at the evidence. Yes, there are indeed some problems, but some of the other issues that we typically see as problems might not actually be as bad as we might think. And just to highlight how sort of clear people think the issue is, let's have a couple of quotes. So Hillary Clinton calls for investors to end the tyranny of short-termism. And while one might think, well, she's more on the left, that's not surprising. Well, to people who are part of capitalism, just argue that short-termism is harming the economy, Jamie Dimon and Warren Buffett. And there's a much less punchy quote by somebody far less influential. This is actually from my job market paper. And that's just to say that, right, even I believe that short-termism is a problem. So if I had any incentive to sort of skew my presentation, it would be to claim that this is a massive problem that needs to be solved. But in fact, things might be quite different. And so just to highlight some of the evidence that people use to try to claim that short-termism is a problem, let's give an article from the Harvard Business Review, which has been very influential. It's from the former dean of Rotman at Toronto, who's a very influential person himself. So he talks about some evidence which claims that if companies were just not so short-termist, we would have an additional 1 trillion in GDP, 5 million more jobs, and investors would also benefit. So both investors and shareholders and workers would magically benefit. There's a couple of problems here. So first is the idea that this article had me at hello, right? So if you start with a prior belief that short-termism is a problem, you're immediately going to believe it is, even if the evidence isn't that rigorous. And also, they said it was in this article, but I went to the article, there was no evidence anywhere which even makes these claims. Now, elsewhere within HBR, there was some evidence from McKinsey, which claims that $1 trillion and 5 million jobs would be quoted. But then when I went to the Harvard Business, the McKinsey study, what they're saying is, well, they're plotting how companies ended up doing, depending on whether they invested a lot. They sort of claimed causality, when, as we know, well, it's the reverse. When your opportunities are good, that's when you're going to be investing more. And they said, well, if we extrapolate from these differences above, then we will get our 1 trillion number, but that clearly doesn't make sense, right? So Xerox, if they were to invest more, that doesn't mean that shareholder value is going to go up. So what I want to do here is to highlight that the question that is short-termism a problem, that's almost the wrong question, because almost by definition, I really like how Toni started with her talk, highlighting what is short-termist and what is not. But if you have the correct definition, which Toni highlighted, then it clearly is a problem. But that's just like asking, is mortality a problem? Yeah, that's clearly a problem. We don't want people to die. But that's not an interesting question. The question is, what are the causes of mortality? Is it diet? Is it exercise or something else? And so I think that's what we want to get to. So my goal of this talk is to highlight what are the causes of short-termism and what might be actually not the causes. And so sometimes some of the remedies that politicians are saying are shooting at the wrong target. So one of the things that people say is a massive problem is shareholder capitalism. So this is the idea that we focus too much on shareholder value. So the European Commission, they released an influential study, which will change law in the EU, saying that the focus of corporate decision makers is on short-term shareholder value maximization. And what they advocate is a move towards stakeholder capitalism, so reducing shareholders' rights, perhaps having workers on the boards or other stakeholders calling the shots. And there are some companies which are changing their corporate form. So Danone in France, they're now an entreprise à mission, which gives them some responsibilities other than shareholder value. But if we think about this more carefully, look at the title of the slide, short-term shareholder value. Well, that's actually a contradiction in terms, because what do we teach our students in Finance 101? Right, shareholder value, that is the present value of all future cash flows, right? Shareholder value is an inherently long-term concept. So it includes something that might happen way in the future. And that's not just hypothetical. Look at the valuations of Tesla and Amazon and so forth. Clearly, they're trading at more than 1 times earnings. And so why does this matter? It's far more than just a semantic issue. It suggests that actually the problem of short-termism is that we need more shareholder capitalism rather than less. Now, that might seem a bizarre statement, but if we think about shareholder capitalism as maximizing shareholder value, and we realize that shareholder value is not short-term earnings, but the present value of all future earnings, then maybe we want more shareholder oversight rather than less. I'm going to present some evidence later on that. And so I think that actually the main problem here is not shareholder capitalism, and the debate shouldn't really be on shareholder versus stakeholder capitalism, But the main problem that we want to avoid is managerial capitalism, where there's a CEO who's not accountable to shareholders or stakeholders, and then she might just pursue whatever decisions that she wants to. And so some of the concerns here with trying to remove shareholder oversight and removing investor rights is that we might just lead to shareholders taking any decisions. And these 3 papers here in the blue bullets are just some examples of that. More broadly than this question, right, there's some papers by Steve Kaplan and Mark Rowe, which are there evidence that the short-termist claims may be overblown? But let me just go back to this idea of shareholder oversight. So there's a couple of concerns that people have with shareholders. And one of them is that when they govern through voice, when they intervene in a company, they cause a company to be short-termist. Well, let's look at that. Alan Braven, Wei Zhang and their co-authors have done so over a decade. And what they found in their first paper was that when an activist hedge fund comes in and files a 13D, the stock price jumps by 7%. Now you might think, well, that's just the short-term reaction. But what they found was in the long term, there's no reversal. Actually, in the contrast, they find that the stock price keeps rising for the next 5 years. So 2 years for holding, 3 years afterwards. Now, just looking at that is not convincing, because you might think, well, the stock price goes up. Maybe it's financial engineering. Maybe you're saving taxes. You're not actually creating value. But in a subsequent paper, they got some census data with Jinsub Kim, and what they found was that return on assets went up. And that wasn't through perhaps sort of turning it into a sweatshop and cutting wages and working their employees more. Actually, labor productivity, which was output per labor hour, that also rose. Well, then what happens to investment? Right, investment is the topic of today's talk, not productivity. Well, if you look at investment, what you find is that R&D expenditure falls. So that might seem the smoking gun that everybody's concerned about. But actually what we care about is not so much how much you spend, but what you're generating with the expenditure. And in a more recent paper, what they found that even though R&D goes down, the number of patents goes up, and also the quality of patents rises in terms of patent citations. So what's interesting about this is it suggests that actually greater shareholder oversight actually will cause benefits for wider society. And some of these are long-term benefits, not short-term benefits. And there's also evidence just beyond hedge funds of other types of active engagement by investors. So private equity, there's evidence now that when they come in, they're improving restaurant cleanliness, they're improving IT investment, which improves human capital, they're increasing the amount of products that stores are offering, and they're reducing the number of workplace injuries. So that actually suggests we do want shareholders to be active rather than to try to move towards stakeholder capitalism. Now, there's another concern that people have, which is, well, maybe shareholders are not being short-termist by intervening, but shareholders are being short-termist by selling their shares too often, right? So they are just turning over their portfolios too much. So going back to Professor Martin, long-term capital is more valuable than short-term capital, plain and simple. There's no question about it, it's plain and simple. If you give me $100, but say that you have the right to take it back within 24 hours, it isn't as valuable to me. So that suggests, well, if you're selling your shares, you're taking your capital away from the company. But as we know, when you sell your shares, you're not redeeming those shares with the company. Somebody else is buying. So the idea that you're selling and then you're short-termist, the company doesn't have capital, that doesn't make sense because you're selling on the secondary market. Well, if we realize that, you might think, well, still, if we sell, then the stock price goes down. And so if there's a CEO who cares about her stock price, she might be worried about investors selling. So isn't the conclusion the same, you might think? We don't want investors to sell in the short term, because if they do that, then managers are not going to be thinking about the long term. And so that leads to a lot of proposals, which are to do things such as to make investors hold for the long term. In France, we have the Loi Florange, which gives them extra voting rights if they hold for 2 years. Similarly, Toyota, they introduced a class of shares where if you hold for 5 years, you get extra loyalty dividends. But the problem with this is it fundamentally confuses 2 things. One of them is the holding period of a shareholder. So whether you hold for the short term or the long term, and the horizon of a shareholder, which is when you sell, do you consider long-term factors or short-term factors? So it may well very be the case that you're selling in the short term, but what's caused you to sell is not a knee-jerk reaction to quarterly earnings being low, but maybe you've sold because you've done your analysis and you realize that even though the company is profitable right now, actually it's mortgaging its future. So as an example, Ford, they hit record profits in 2015 and 2016, yet the stock price went down because people realized that it wasn't investing enough in self-driving cars or electric cars. So this is very important. Also, it's important for academia because we often use holding periods of investors as a measure of short-termism, when in fact, actually what you could be doing when you're selling is you could be selling based on long-term information. And so that was what I was modeling in my job market paper. And so what the important thing is in terms of investors is the stake that they're having. Because if you're fragmented, right, maybe as an investor, you don't have skin in the game. You don't bother to look beyond quarterly earnings. You're just going to be reacting to that. But if you're a large shareholder or a block holder, that does give you the incentives to do your own research. So there's the quote from Graham Harvey and Rajgopal that the market sells first and asks questions later. But if you're a large shareholder, given your skin in the game, you've got the incentives to ask the questions first and not react in a knee-jerk manner to quarterly earnings. Okay, so the bottom line here is, well, rather than saying we want to prevent investor selling, we want to prevent the wrong type of investor selling, uninformed selling based purely on financial information. And the way to do that is to encourage larger stakes, because when you have larger stakes, then you have the incentive to do your own research. Okay, some quotes here about share buybacks, but let me actually just skip this in the interest of time and instead get to executive pay. So I've talked about one potential cause of short-termism, which I don't think really is a cause, which is shareholder capitalism or shareholder engagement. Now I'm going to get to two causes, executive pay and quarterly earnings, which I do think are issues. So let's start with executive pay. And so this was the Stein paper, which Toni mentioned, which shows that short-term pay leads to underinvestment. So that's something I looked at empirically with Vivian Fang and Katarina Llewellyn a couple of years ago. And so what we showed was that when a CEO's equity is about to vest, then she typically cuts R&D, cuts CapEx, and is likely to exactly meet or just beat earnings targets, suggesting that this leads to a short horizon, and so she's focusing on earnings rather than long-term investment. And so we achieved our identification with vesting equity. The idea is that, well, if you were giving a chunk of equity 5 years ago and it's vesting this year, that was something which is uncorrelated with current investment opportunities. But independently, Tomislav Ladika and Zach Sortner had separate identification, where they looked at FAS 123R, which was accounting change, which required companies to expense any unvested options. So what some companies did is they accelerated the vesting of their options to avoid this expense. And interestingly, they were able to have a treatment control group because when this kicked in depended on when their fiscal year was ending. And again, what they found was that companies that accelerated the vesting of their options ended up cutting their investment. Okay, so that suggests short-term pay may cause these negative consequences. Theoretically, it might not be surprising in a couple of theory papers that long-term pay is the solution to this. What's the evidence? So Carolina Flammer and Tima Bansal, they do a regression discontinuity where they look at what happens when when shareholders put in a proposal to pay CEOs according to the long term. Well, as we know, these proposals don't arise randomly. Maybe it was a large engaged investor that put in these proposals, and maybe it was a large engaged investor that led to future outcomes. So what they look at is proposals which pass with 51% of the vote and ones which fail with 49% of the vote. And they find that when these proposals are passed, what happens to profitability? It dips, but it only dips in the short term and actually rises in the long term. Also, innovation goes up, and the performance in various stakeholder dimensions goes up. So again, this goes to the idea that what we need is more shareholder capitalism rather than less. Right now, there's proposal to change how executives are paid, perhaps give them ESG targets and so on. When in fact, if you're still giving them stock price targets, but those stock price targets are maybe in 5 years' time rather than 3 years' time, then the CEO will automatically invest in innovation, invest in her stakeholders, because she knows that these things will pay off in the long term, and that might be the better way to encourage investment rather than to have explicit ESG targets. Okay, so the final thing I'll talk about is quarterly reporting. So the most famous paper here is by Graham, Harvey and Rajgopal, where they found that 80% of CFOs would freely admit to cutting investment in order to meet an earnings benchmark. And you think if there's any misreporting in the survey, they would not want to admit to such behavior. So the fact that 80% said they would do was very striking. A couple of theory papers are showing how that's linked to investment. Some of you will know Heitor Almeida's keynote at the SFS Cavalcade a couple of years ago, suggesting, well, should we move away from EPS? And that was based on some of his own work. So what he found was that in general, share buybacks don't actually cause underinvestment like we think. So that was what I skipped in the interest of time. However, if the share buybacks have been caused by the desire to hit an analyst EPS forecast, then that does have some negative consequences. It leads to lower employment and investment. Again, here we have to be careful because lower employment and low investment need not be a bad thing, right? Let's think about a free cash flow problem where managers always overinvest. Maybe an EPS forecast makes you get your act together and cut some bad investment. So what they did in a follow-up paper is they tried to look at the productivity of the investments that were being cut, again, using census data. And they found that in general, those cuts, you might think they should be dependent on plant productivity, but particularly in the case where there's a labor union, then the investment cuts are made across the board. They're not dependent upon productivity as an efficient cutting would suggest. Okay, so before I hand over to Thomas, so where does this leave us? Right, short-termism can be a problem. It can affect investments, but rather than saying short-termism is a problem, right, we want to look at the drivers of short-termism that might be causing it. And two things that I think are concerns are some horizons of executive pay and quarterly earnings reporting. But one thing which I don't think is a concern is shareholder capitalism when we recognize it's an inherently long-term concept. So actually some of the solutions should be more shareholder oversight rather than less. And one of the things I skipped was share buybacks. If you look at the evidence on the long-term returns to companies that engage in buybacks, that's actually positive. To the extent to which share buybacks are a problem, which were in Heitor's papers with his various co-authors, those are buybacks caused by quarterly earnings benchmarks, not buybacks themselves. So they're often the symptom of the problem, not the underlying cause. So any solution should be targeted to focusing on quarterly earnings rather than buybacks in particular. Thanks very much again to Toni for this opportunity, and let me hand over now to Thomas.
Thank you very much. So thank you, Toni, for putting this panel together. And yeah, so Jan early on spent quite a bit of time showing us the quantities. So I'm going to look at prices a little bit. So it's going to be complementary to what Jan said, and then tell you my takeaway. So if we think about prices, the first thing that would come to mind if we think about short-termism is, are we discounting the future too much? And so, you know, based on interest rates, you would of course think the opposite. So you have the Fed funds rates. Here you have in yellow you have the 10-year tips rate, so real, and then you have the one that I find probably the most informative, which is the Lowback-Williams natural rate of interest for the economy. And as is well known, over the past 20 years, we have a decrease in this natural real interest rates. So that's against the idea that we are discounting the future too much, or definitely more than before. If anything, we seem to be discounting the future less. So this is the interest rate. That's the return for the savers. So if we think about investment, then of course what matters is the cost financing. So you will need to add the cost of financial intermediation. So when I look at it in the long term, I find it's around 200 basis points. Once you take into account changes in the quality of financial intermediation, maybe you think it's between 150 and 200 basis points. It's been stable for a long time, more than a century. But in recent years, if anything, it's come down a little bit. This is in part thanks to some technological improvement, in part some competition brought about by entrants in the financial intermediation world, such as fintechs, for instance. But so again, if you look at this, you would conclude that the real interest rates for investors are lower. The unit cost of intermediation, if anything, is slightly lower than before. So on the price side, there is no reason to think that we discount the future more than we used to. So I don't think from that you would conclude that there is a strong evidence for short-termism. But on the other hand, as Jan showed earlier, if you look at actual investments, it's disappointing. Since Jan explained extremely well all the issues with the measurement of intangible assets, I won't go back in there. But broadly speaking, what you see is that on this figure, the fitted value is the net investment rate. So it's net. Remember the key point that Jan mentioned earlier, that the gross investment is one thing, but then you subtract depreciation rates. And it matters because of the change in the composition of the capital stock away from structures and towards intangible investment that have a higher depreciation rate. So if you think about the growth rate of K, you need to look at the net investment rate. So the red line is the net investment rate you would predict from Q theory, just based on Tobin's Q. And trying to count, of course, tangible and intangible investment. And the green line is the actual investment series. So as you can see, it seemed to fit relatively well in the 90s, but somewhere in the mid-2000s, you have this growing gap between what you would predict based on valuations and what you see firms doing. So that might be the issue we worry about today. It's not that values are low, so it's not that we discount the future too much, but it looks like despite high valuations, we don't see as much investment perhaps as we would like. The flip side of it, of course, is if firms make a lot of money and they don't invest that much, then the money must be going somewhere. And so the payout rate, so that is the ratio of total payouts to assets as being and going up, and the increase again coincides with what we saw in the previous picture, is mostly something that happens in the 2000s. So now if that brings us to short-termism, so that's a little bit like the equation that Toni was showing early on, but written in a recursive form. So the value today is the profit plus the discounted value of the future value next period. And when you discount, you have the interest rate. And you have, of course, the risk adjustment. That's why I put Q there to remind us that it's just under the Q measure. So when we said the markets are short-termist, perhaps we mean they discount too much, or perhaps we mean they are too risk averse. No, I don't want to go too much into risk aversion because I don't think that's very strong evidence for that. I would argue that the idea that there is excess discounting or short-termism on average is just not plausible for many of the reasons that we've discussed already. So I don't think that's where you would look for the issue. But instead, the issue might be in the allocation. Okay, that is, a market can be long-termist on average, so there is no systematic bias to underfinance long-term companies. So there is no systematic bias to finance Tesla or Amazon. But it doesn't mean that the market does a good job at allocating the capital efficiently. So this is research I've done with Jenny Bai and Alexis Savov, where we try to see, does the market give us valuable information that would improve capital allocation over time? So essentially asking whether the vector of all prices of companies today, if you were to use that as an input in a capital allocation problem, so essentially you would allocate more capital to firms that today have a high value, a high implicit Q, would you do better than just randomly allocating capital across firms? Okay, and well, the answer is yes, you do better. Thankfully, that means that current prices are predictive of future productivity growth. So if you follow the hint that you get from market prices, you would allocate more capital to firms that end up having higher productivity growth. So that would, this allocation would make the economy more efficient over time. So this is the efficiency of the allocation based on market prices as a function of the investment horizon. Now at zero, of course, this is today, so you already have all the information. And you see it's growing for the first three years. After 5 years, it's flat. So that's telling you that market prices are pretty good at predicting productivity in the 2 to 5 year horizon. That's sensible also because, you know, given the investment lags, that's why it's most useful. Now, the thing that's a bit more disappointing is quantitatively, the improvement is not that great over time. So in the paper with Bai and Savov, we try to ask, okay, so let's build that metric, which is literally the metric is telling you the extent to which you would improve aggregate allocation if you followed market prices rather than allocating capital randomly across firms. As we've seen, it's a positive number, so you do better if you follow the news from the market. But how much better? Well, a little bit better, but it's not, you know, dramatically better. And more importantly for me, there is a little bit of growth over time, but the growth in the efficiency of allocation does not seem to be commensurate with how much resources we spend in financial intermediation. Or in other words, the financial market seems to have gotten slightly better at allocating capital over time, but the bang for bucks is not that great. Okay, which suggests that perhaps what we have within the financial system is some misallocation of financial effort. So one example could be that you know, it might be more profitable for an intermediary to try to forecast financial flows and short-term returns, which is then in a finance model mostly means you try to predict the trading behavior of others rather than spending resources to forecast true gains in fundamental productivity. Okay, 2 ways you can make money. You forecast the trading behavior of others. So it's like front running. It's perfectly legal front running. It's just not that great in terms of aggregate efficiency. Or you could spend resources trying to improve your prediction about the fundamentals of companies. And clearly we know financial intermediaries, hedge funds and various trading agencies, trading systems, they do both. Okay, what I suggest is that perhaps if there is one form of short-termism, is that the relative allocation between figuring out long-term fundamental value versus short-term trading flows is a bit biased towards short-term trading flows. So that's about the asset pricing side. I think the other part of the equation, if you go back to this equation, so this was focused on this, you know, the future part. Now, of course, short-termism come from the profits today. Okay, so it could be that finance, it's not that that finance pushes you to discount the future too much, is that finance pushes you towards behavior that is not optimal for the long run health of the economy. So it's not privately short-termist at all. It's just, it's a sum of allocation that end up looking like at the aggregate level a bit too short-termist. So I don't think there is a plausible case that finance do it by itself, but you can build a case that it does it by interaction with. Or in other words, I don't think finance creates the issue of short-termism, but if there is another force that creates potential for short-termism, then finance can reinforce that problem. Now, the one I've been looking at recently, of course, is the issue of monopoly power. And there, I think you can build a plausible case that, of course, if you have monopoly, you're going to have underinvestment. But it could interact with the financial system in the sense that there's some form of modern financial intermediaries that would push firms to maximize their monopoly rents. Okay, successful investors, Buffett being, of course, the one that always people bring up, are very good at figuring out which firms have built moats around their businesses so that they can protect their margins going forward. So in that case, the fact that investors become very good at spotting future monopolies is not necessarily good news for the economy as a whole. There's also the issue of killer acquisitions that is linked to corporate finance, which is again privately optimal, but might not be socially optimal. So is there some evidence for that? Well, if you look at the data, of course, just think about the pure asset management side as an example. Of course, we know there is rising ownership by large asset managers. And we know that at least from their self-reporting, from what they declare or from what they discuss during earnings call, that they do put a lot of weight on, profits and payouts. And at least in the data, it seems to be consistent. That is, if you break down the overall increase in payouts that I showed you earlier, it's stronger for firms that have a lot of quasi-indexer in their shareholder base. So you could argue that, these potential monopoly rents have always been there, or maybe they are stronger today. But what finance might do is push firms to exploit these monopoly rents to the maximum, which then could look like some short-termism at the aggregate level, even though it is not at all based on the fact that they discount the future too much. The last thing to conclude is where I think the true issue of short-termism could show up is when it comes to the big investment that should have a public sector component. And there, we did not coordinate, but I completely rejoin what Janice was saying earlier. If you worry about short-termism, I don't think the private sector is the place you want to worry. To a first-order approximation, I just don't think there is strong evidence that the private sector is very short-termist, and I don't think there is strong evidence that the private sector has become more short-termist over time. There is evidence that this is in the public sector, things might be different. And so if you think about the one problem that we face, which is definitely a short-term versus long-term investment problem, that's climate change. And there the worry is not so much that the financial market will not be able to discount properly the value of stranded assets. I think that if the market forecasts that assets are going to be stranded, the value today of these assets is going to be hammered immediately. And I think that if you build a plausible case that a company is going to be very resilient to climate change or is going to strive because of innovation in technologies that would help us against climate change, I don't have any doubt that these firms would be highly valued by private investors. But I think the thing I worry about is that this would not be enough because we are dealing with externalities. And so the issue is whether the public sector is the one that is long-term enough to put in place the right incentive for then the private sector to invest efficiently in remedies against climate change. So I think that's the kind of, at the end of the day, having looked at the evidence, that's the part of the short-termism that I'm more worried about. Thank you.
Great. So now we're going to move on to the question and answer part. And so if the panelists want to look through the questions that have already been typed and signal which ones they might want to answer, I'm just going to go through, read the questions, and then either pick the person who volunteered to answer or volunteer somebody. So here we go. So the first question is from Brandon Castle, and he writes, of the studies mentioned on activist investors, did those papers notice any correlation between the business cycle and the initial investment by activist investors? If so, would that skew the data results of those papers? And Alex has said that he will answer this.
Sure. So let me actually get some slides which are from the paper. So I think the concerns are a very valid one. So this is what Alon Wei and Hyunsub show. So what I have here is what happens in terms of ROA of the plants that are targeted by hedge funds. And you might be concerned here that maybe they're being targeted in a decline, and so they just bounce back, and that bounce back would have just happened anyway because of where they were in a cycle. So what they then do is they will compare those plants to otherwise similar plants which were not targeted by hedge funds. And so this will hopefully address the concern where you have the matching plants in red which have a decline and then they just stay at that low level of performance, whereas the blue were the ones targeted by hedge funds. And so that attenuates the concern that it was just something which was cyclical and would have happened anyway.
So next one. I'm not going to go in order. So the next one is from Stephen Kaplan. How is outsourcing, particularly to Asia, treated in the Eberly and Philippon data? It looks like the drop in the Philippon data coincides more with outsourcing. So Jan has volunteered to answer this.
Yeah, and Tamaya should jump in as well, since I think it applies to both of our comments. But in the quantitative data on investment, you can get at this because through looking at a combination of both the aggregate, like the national accounts data, as well as CompuStat data. So in the national accounts data, it is only looking at domestic investments. So the issue that Steve raises about outsourcing would be a concern, because you wouldn't capture capital that was used outside the country. But in the CompuStat data, firms are reporting, at least to the extent that you're capturing within a firm what they're doing abroad. That's measured in the CompuStat data, because it's not limited to what they're doing domestically. So the investment includes what they're doing abroad. And in both of these data sets, you see almost identical trends. So I think the overall trends that we're seeing in investment are not driven by just the outsourcing. Now, what you're not going to capture in the CompuStat data is whether there's something different going on in private firms. Though that also shows up in the national accounts data. So it could be, you know, a feature, but you need to find something or a mechanism that's not captured by either the national accounts data that, you know, captures what's happening in the map versus the CompuStat data, which captures what's happening within publicly traded firms.
Yeah, no, I agree. That's the first order answer is clearly that you have domestic investment that you get from the domestic national accounts. If you want consolidated, you can consolidate at the firm level. If you think about outsourcing, I think the one place that we potentially would miss some of this action would be induced investment. So, you know, say Apple, for instance, you would measure in the consolidated accounts the investment directly by Apple. But if Apple decides to locate in a particular region and then induces a large increase in investment by firms, by local firms, okay, that could be part of a boom in investment that would not be measured in the US, not be measured in the consolidated accounts of Apple, but we would pick it up at the world level. So for that kind of thing, you would at some point need to consolidate the world and look at world investment series. Now, I didn't do that. The IMF did some version of that. And if you do it that way, you do find still that there's less investment than you would imagine, but it's true that it's in some countries, there is a pickup in investment.
Okay,
and I think what Tomas just said is Steve had a follow-up question about Foxconn and that it's not Apple's capital, and I think that's what Tomas was just talking about. So that's harder to capture in either the national accounts data or.
Oh yes, I just saw Steve's new question.
Yeah, that's
yes,
the follow-up. So that's exactly
great.
what you were.
So
what
I answered by anticipation.
Okay, great. I'm going to now come back to a question by Hong Liu. He says, while underinvestment may be a significant manifestation of short-termism, why cannot overinvestment also be? I missed Toni's definition of short-termism, but it seems to me any decision to increase short-term performance, evaluated by whatever measure the decision maker cares about, at the cost of long-term value reflects short-termism. If so, overinvestment and some other suboptimal decisions may also satisfy this definition. Alex offered to answer, but I would also like to just butt in and say one word first. Absolutely. You can have short-termism. It doesn't have to be overinvestment. And in fact, you have these papers that look at extrapolative and expectations, and they show that it can manifest itself as overinvestment. So yes. And Alex?
Yeah, thanks. And thanks, Hung, for the question. So you're absolutely right. I think the key theory paper here is Bebchuk and Stoll, JF 1993. So let me try and give what I remember about the paper. It depends on the underlying model. So if we think we can observe earnings, but we can't observe investment, let's say investment is something like, say, employee training, which is mixed up with wages and all of those other things, then you will indeed underinvest because you're going to be cutting those investments in order to boost earnings. But there could be another model in which you can observe investment, right? We can observe capital, but you can't observe investment opportunities. And so there might be companies that invest a lot in order to dupe the market into thinking that there's good investment opportunities when they're not. So you're absolutely right. It could be overinvestment rather than underinvestment. So I think the general definition of short-termism is anything that you do to deviate from optimal investment behavior to increase the market's perception of your value. So why is that important? And that means that empirically, we can't just look at cuts of investment and say, well, you're short-termist. As I mentioned briefly when I talked about Hato Almeida and Cortha's papers, it could be you're cutting investment, and that's good because you're reducing some bad investments, you're reducing empire building. So there's other things that you'll need to do in order to try and show that investment cuts are a bad thing rather than actually cutting some overinvestment. So what I do in my paper with Vivian and Katerina is the idea is that investing equity causes the CEO to get her act together and improve efficiency more generally. We would expect it to also lead to cuts in operating expenditures, increases in sales and so forth, and we don't find that, so it's not that this was part of a general efficiency program. And also we can do some cross-sectional tests. We can find that there's more cuts in of investment when the CEO is closer to retirement, so there's less reputational concerns, when there are not those block holders who will see through potential short-termist actions and so on. So you need to work much harder rather than just looking at investment cuts, because as you say, investment cuts could be a good thing. And the final thing I'll say is that this is why stakeholder capitalism can still be short-termist, right? People are arguing, well, let's have these metrics of how much you donate to charity or how much you are going to invest in even your employees, even though that's something I care about, right? So it could be that if we're going to tie managers' pay to these short-term, to these ESG targets, you could do things in order to hit those targets, even if they're not in the long-term interest of the company through such things such as overinvestment, which is why, again, I want to emphasize the importance of shareholder accountability in all of these things to make sure that you're maximizing investments opportunities from what's good for shareholders.
And just a follow-up on that, because I think a number of the issues that arose and that Thomas raised as well are not so much about short-termism, but as a distinction between the social and private return to capital. And that's come up a few times. And that also, in response to Hong's question, can lead to overinvestment as well as to underinvestment. And Thomas and I both mentioned intangible capital. That's a classic example, because you could see intangible capital being used to create these virtual workspaces that enabled us to work during a pandemic, and so contributing to output. But you can also see intangible capital as creating the moats that generate rents and market power because of marketing or branding or even some forms of patent protection as well. So it's overinvestment is as much a possibility in that world as underinvestment, as Hong points out.
Okay, let's move on. So the next question is from J.M. He says, is short-termism relevant for the aggregate underinvestment? Is short-termism playing a role in the post-2000s underinvestment puzzle? If so, would it have greater effect only after the 1990s? How do we measure the short-termism effect on firm aggregate level investment among other channels in the literature? Thomas, do you want to take a shot at that?
Yeah, but I give you my own perspective, which is I don't think that I think that short-termism is an outcome. It's not if it exists, it's an outcome. It's not really a cause. So the cause could be mispricing in financial markets. It could be imperfection in corporate finance, or in executive compensation, like Alex was emphasizing, or it could be issues in the real economy, such as, in my case, monopoly rents. So the reason I think we do have an issue of underinvestment in the private sector in the US today is I think that some industries have become too concentrated and not competitive enough. So firms have a pretty good option for making significant cash flows without investing a lot. There is not enough competitive pressure. And then we have potentially, that's where the interaction with finance appears, which is you have financial intermediaries and institutions that have become really good at forcing firms to spit out cash flows. Now, if you force firms to spit out cash flows in a competitive economy, it's great for welfare. You just make, you just improve the efficiency. But if you do it in an economy where the goods markets are not competitive enough, then you can reinforce the issue of monopoly rents. I mean, one way to think about it is what the financial market is good at is forcing firms to maximize profits. I think that's kind of one thing we can agree on. And so then it boils down to, we've built an industry, a set of institutions that are pretty good at putting pressure on firms to maximize profits and value. And the question is, does that coincide with a good welfare, a good outcome for social welfare? And then that's just back to the first and second welfare theorem. So if the markets are competitive and the externalities are priced correctly, then having a financial sector focused on forcing profits to be high is a good outcome. But if you move into a world where the gaps in competition in some markets or the presence of externalities due to climate change become relatively larger, then the same institutions that were good in the past, because focusing on profits was good, might not be so good anymore. But it doesn't mean the solution is to change the financial industry as opposed to fixing the externalities where they appear, which is in the goods market for competition and goods and services, and in the externalities for climate change.
Okay, we've got one more. So let's see. So we've got a question from Bhavik Parikh. He says, does corporate tax policies matter for short-termism? Maybe. So I think I gave one example in my introduction, which is depreciation. So there's this enormous literature that Alex has certainly worked in and that I've dabbled in, which is that firms try to manage earnings by cutting real expenditures. And to the extent that tax policy can make that real manipulation more effective. So for example, by allowing the 100% deduction of equipment, then perhaps, yes, it could change incentives and allow for more short-termism. Does anybody want to
I think I have a slightly different take on that one. Yes. I mean, I agree with what you said, but I think the main way that tax policy increases short-termism is just by adding unnecessary expenses to the system. So, if you make a system full of loopholes, then you're going to create an industry of lawyers who are going to spend their time minimizing the tax bill of either wealthy households or firms. Now, individually, this is not short-termism. They are doing exactly the right thing. In fact, they are probably maximizing very long-term values. But from society's perspective, this is the definition of short-termism, because you're increasing the amount of expenditure on an activity that has zero return going forward, because it's a pure zero-sum game. So I think tax policy matters a great deal. But to me, at least, by far the first order thing would be to simplify it so that all the activities that are utterly useless would disappear. That would be a first order improvement against short-termism.
Thanks. In addition to simplifying, I think harmonizing, for example, differential tax rates on debt and equity. So the fact that debt interest is tax deductible. Like if we teach basic APV to our MBA students, we know that if a project is negative NPV, if it's all equity financed, but there's the tax shields, it can become positive NPV overall. And so that could lead a company to taking an investment which otherwise would be negative NPV just to get the tax shield. So there's a paper by Francisco Perez Gonzalez and co-authors looking at what happens if you subsidize equity, and that leads to the capital structure decision being driven by other factors rather than just taxes.
Okay, next question. This is a question to Janice, which may be of limited wider interest. Oh, I seriously doubt that. That's my interjection. Other than the space program, does the large public investment in the 50s reflect the construction of the interstate highway system? Does anybody?
It does. Yeah, let me show you the data.
Oh, cool.
I have here. All right, can you see that slide? That shows the composition of government fixed assets, and highways and streets are this bright blue here. So you see this, this is relative to GDP. So this is the 1950s, and you see this very large component from the highways and streets, which includes the interstate highway system. So that was begun post-World War II. There's lots of interesting stories about what led to it. It was actually not intended as a contribution to the private sector. The case that was made for building the interstate highway system was about the importance of moving military supplies across the country. Because they'd had this experience that it took weeks to drive cross country, the large military hardware. So they built the interstate highway system with that motivation. And you see it's a big part of the capital stock. What may surprise you is that educational structures are also a huge part, because government fixed assets also include state and local fixed assets. So the educational system historically was also a big part of the fixed assets. So yeah, all of those sort of physical capital components are a large part. This little part up at the top is the government part of the intellectual property. So when I said intangibles were not important in the public sector, this is why. So it's quite not only declining overall over time, but the government investment in intellectual, or the government share of intellectual property, but also things like software and data has been pretty small. And you know, as we think about government effectiveness, that lack of investment is, we may be seeing the results of that.
Just on that one, I think the metaphor that people often use today, of course, when they think about the 1950s investment in the interstate highway system, is the broadband connection. So the fact that today you still have a fairly large fraction of counties in the US where very few people actually have high quality broadband access, looks very much, even more so post-COVID, but already before COVID, looks very much like a failure of public policy. Because if you think about the infrastructure that today is a bit like the highway, like the thing that we should all have because it's just bread and butter for being productive. And that would have probably good externalities on the private sector. That would have been making sure that every American household has access to high-speed internet at a reasonable cost. And that's a thing that did not happen in the past 10 years.
And you see it in the distributional impact of work from home, right? The work from home industries are much more likely to be urban professional industries as well. So it's both geographic and industry distribution.
Okay, so Francois Goriot has a question. Going back in time to the 60s or 70s when shareholder capitalism and executive compensation incentives were less prevalent, do you think we had overinvestment then? And so Alex volunteered this one.
Thanks. I thought I'd volunteer because it has said executive compensation in the question. So I think the answer is yes. And so perhaps the best cited paper is Mork, Schleifer and Vishny, JF 1990. Do managerial objectives drive bad acquisitions? And the idea is that if you don't have equity skin in the game, you're more likely to overinvest because of empire building, increases in pay and so forth. And so we had in the 1970s a lot of cases where managers would overextend themselves. So they would invest free cash in diversifying acquisitions. That was one of the reasons why the private equity industry became so popular, is it added value by curbing the overinvestment that some managers which were not aligned to shareholder value were engaging in. So there's work of Steve Kaplan and others which suggest that. So I would say yes. And so one of my concerns is that if this move away from shareholder capitalism goes back to the 1970s and has this managerial unaccountability, then we might indeed have the problem of overinvestment that Hong Liu was referring to earlier.
Okay, so then Wei Zhu has a question. While some short-term investors can trade on long-term information, some recent short-term investors like high-frequency traders trade less on fundamental information. How would you predict these investors' effect on investment?
Yeah, okay, so I think that one is more for me.
Yeah.
Yeah, so I mean, there's a couple of recent papers that try to also explain that in a formal model, but I mean, you can look at the work of Laura Weidkamp and her co-authors. But the idea is, if you, one way we think about financial markets is that they produce information which improves the allocation of capital. That's what I was showing in my slides. Now, of course, they don't do it to improve the allocation, do it to make money. So the question is, does the profit motive lead to the right type of information acquisition? And I think you can write a model where there's two ways to make excess returns if you are an informed trader or if you're a smart investor. One is you build a better prediction of long-term fundamental value of a company. And the other one is you predict short-term returns. Now, in this class of model, typically what you need to predict is the trading behavior of other investors. Okay, so if you know in advance, as in any model where the demand curves are downward sloping, then if you have a shock to trading behavior by any party, somebody's going to sell a large share, or somebody's going to buy a large share. If you can predict that 1 period in advance, you will be able to make excess return by trading on the short-term price changes driven by the flow of new trades. So now as an investor, as a trader, you have two technologies you can invest in. You can invest in forecasting the trading behavior of others. You try to forecast trading flows, or you can try to forecast the long-term value of companies, something more like linked to the real economy. And you can easily see that in a model, oftentimes, the investors, the traders are going to optimize until the two margins are equally profitable. But from a society's perspective, when you try simply to forecast the trading behavior of other investors, that builds in a slightly larger or sometimes much larger zero-sum game component, so that the social return to that activity is lower. And therefore, in the aggregate, you have a bias towards too much short-term trading, if you want.
And it looks like Alex also wants to add to this.
Yeah, so just add one paper to back up what Thomas just said is Hedge Funds and the Technology Bubble by Brunnemeyer and Nagel in JF 2004. So what that suggests is that hedge funds, even though they knew that the tech companies were overinflated, well, they're actually going to make money if they think that the bubble is going to grow even further by riding on that. However, I would like to also put some counter evidence here. So the idea that high frequency traders will always be trading less on fundamental information is not always clear. So there's a RFS 2009 paper called Are Short-Term Institutions better informed? I'm going to type it into the chat, the full citation, which finds, well, the answer is yes, actually, these short-term investors are actually better informed in terms of predicting long-term returns better. A more recent paper by Pastor, Stambo, and Taylor is called "Do Funds Make More When They Trade More?" That's not a cross-sectional test, that's a time series test. But at the times in which mutual funds are trading more frequently, they're actually making more money. And the idea here is that, well, when you have information, then that information is what's going to cause you to trade. Now, that information could be based on other people's trades, as Tom was saying, but it could also be based on long-term fundamentals. I can't remember from the paper which it is, but certainly it's not unambiguous that actually short-term trading is necessarily a bad thing. It could be that you're trading based on some long-term fundamentals, in particular if you're a large investor, because if so, that gives you the skin in the game in order to look at fundamentals rather than just to look at public information.
Okay, it looks like that is as many questions as we have right now. If the audience wants to have a minute or so just to type in something if they have another question, go right ahead.
In the meantime, I'd ask a question to Alex and Thomas, if I can, based on what we've been talking about. So Alex, in your presentation, one of the remedies you advocated for was more concentrated ownership in order to overcome, so take a longer view and evaluate trade-offs perhaps better than more fragmented ownership. But I took away from Thomas' comments on social or concentration in general and differences between social and private returns, that measures like that might be useful and beneficial in some circumstances would actually be counterproductive in the kind of world that he was thinking about. Thomas, would your comments apply to concentration of ownership? Do you think it's counterproductive in a world where there's this moats and the market power concerns that you raise, or do you think it's actually part of the solution?
I think the evidence is a bit all over the place, so I don't have a very strong view on that one. I mean, first of all, you have the debate on common ownership, which is about not so much the level of concentration, but about the allocation. So because in Alex's world, you could have each firm has a significant block holder who cares about the long-term value of that firm, but each block holder is different for each firm, in which case there would be no common ownership issue. Or you could imagine implementing it by having a few large block holders for the economy as a whole, and then that brings, of course, the issue of common ownership, which is like a whole literature on its own. But from what I see in the data, the things that, I think at least my view is consistent with the idea that large asset managers are pretty good at putting pressure on managers to increase payouts. And in a world where you worry about managers wasting the money on their pet projects, that's good. In a world where you're worried about firms having market power, then that might not be that good. So that's at the end of the day, that's more or less where I stand.
I think it's a very good question, Jan, and I think there will be an optimal size of the block holding, just like there is with managerial ownership. So if I go back to another Mork, Schleifer and Vishny paper, then 1988 one shows that, well, once you have more skin in the game for a manager, that's good for firm value, but after a point you then become entrenched, and that may well be the case with block holders as well. But I think given the fragmentation that we currently have in the US and the UK, we're probably not past the optimal point at the moment, which is why the evidence of the hedge fund papers where you're looking at a 5% stake, not sort of a 25% stake where you might have tunneling. That's suggesting some positive effects. There's also that Aghion, Van Reenen and Zingala's paper in the AER probably about 10 years ago, which looks at when we have greater institutional ownership, and they use inclusion in the S&P 500 to get some identification there. That leads to greater investment in R&D and so forth. So I do think it generally will be beneficial, but it may well be in other regimes where maybe if concentration is already really high, then you're going to be worried about tunneling and then some of the other issues.
Yeah, I mean, the one thing, going to Jan's point, I think there's one thing in my mind that's not clear at all is how do we think about the frontier between privately held and publicly traded companies, and whether that line is drawn in the right place. I don't think I've seen much research directly on that, to think about, first of all, how do we even think about that issue? Do firms making the decision to go public, are they making it at the right time from a social perspective? And is that trade-off has changed over time? I mean, we know the number of listed firms in the US has declined dramatically in 20 years. Is that a good thing or a bad thing? That's the part where, so I guess, Jen, you see, to me, the bigger uncertainty would be more that frontier between public and private, because that one has been shifting a lot. And I don't really have a strong idea of whether it's good or bad to have more or less public or private firms. Rather than condition on being publicly listed, do you have a few too many Vanguard and BlackRock in your capital base or not?
Yeah, so people will look at, say, the decline in the public firm and say, well, that's definitely a bad thing, and that might prove short-termism. People don't want to go public because they're going to be beholden to the vagaries of investors. But another rosy interpretation might be that it's now easier to raise capital as a private company. So Song Ma, his job market paper was on corporate venture capital, which is now you can raise sort of venture capital financing by being part of a large company. If we have a more active VC sector, maybe you don't need to go public. Maybe actually bank financing is something which addresses financial needs. So I don't know where we are, and I know I'm not giving an easy answer to this question, but people do lament the decline of the public corporation. But that's a relative statement. It could be that the pub being a private firm is now more attractive rather than a public firm being less attractive.
And if it's about financing, it sort of elevates the question to the next level as why is it easier to raise financing for a private firm than relative to the past, relative to a public firm?
So we have one more question from anonymous attendee. It says, do any of your studies show a difference between short-term capitalism between large and small cap companies? Does anybody know the answer to that? I do not.
Well, again, I think it depends what we mean by short-term, short-termism. But there is, of course, because of the the increase in the valuation of very large companies, then there's a very active literature looking at whether you reach a point where if you are the number 6 or 7 or 10 in your industry, you are so far behind the leader that you just give up on the idea of being able to catch up. So you can think of it in models of Schumpeterian growth, where you have neck and neck competition, and you invest in the ladder of quality. And at some point, if you're too many steps away from the leader, your optimal strategy is just to give up on innovation altogether. So I don't think we have strong evidence that this is happening, but we know that it could.
So I think this is the end of the questions. And unless any of you have anything more to say.
There is one question which says, are the slides being put on the AFA website?
Yeah.
I do know the answer to that, but
there's no way for us to upload our slides. There's in the same way that we can upload our papers.
Okay,
I'll post my slides on my website. Okay. Well,
thank you, Toni, then.
Oh
Thank
yeah, and thanks
Thank you so
Jan,
much.
Alex, and Thomas very much for it. I enjoyed this. I learned an enormous amount. So for me, it was just a great consumption opportunity. So thank you very much.
Bye bye, everyone.
Thanks very much.
Bye bye, everybody.
Bye.
Bye.